So we still think we'll see some announcements of tapering this month. It may be a timetable that's implemented later in the year, maybe an actual start straight away. But we should remember basically the tapering policy is going to be basically a slowdown of the pace of expansion of the federal balance sheet. So they'll still be expanding. And this is a debate between the market and academics and policymakers. Academics and policymakers like to say it's the size of the balance sheet that's important. It's going to be having an effect on markets, on emerging markets. But actual traders and investors themselves are looking more at that marginal change. And that's the sort of impact that's winning out. But I think people will realise after tapers happen that it isn't a sudden be-all and end-all for emerging markets. This sort of pot of free money is not suddenly being withdrawn. So that's why we see it more of like for South Africa as an opportunity to risk reprice the story. We've already seen that happen through May, a weaker currency now. South Africa got that out of the way early. And the steeper yield curve here as well probably is the event that's still to happen on that front. But not an outflow crisis, balance of payments, call in the IMF type story at all. I think the market's priced it in very well so far. Even up until about a month ago, we probably were still sort of 75% priced in, perhaps less. But actually, the story at the moment is what sort of concerns and vulnerabilities you're thinking about and pricing in within the context of the taper. So what sort of vulnerabilities are you looking at? Is external vulnerability, current account, external debt? On that front, South Africa has a mixed picture. In flow terms, it looks quite bad with the current account. In stock terms, with external debt, it looks okay actually. Or are you looking at growth? Which is one of the other possibilities the market can look more at. On that front, South Africa will not do as particularly well as you compare potential growth versus other emerging markets, the implications that has on fiscal and things like that in the long run. So I think South Africa, again, on this picture has broadly priced in the correct amount of negativity with us around 10. And actually, in terms of thinking about external vulnerability, we think somewhere around 975 to 10 in the long run actually is an area where you can deal with some of that vulnerability in terms of closing the current account slowly over time. A slight boost to competitiveness, though we wouldn't overplay that point very much at all. So for us, we're at fair value here, and the market is correctly pricing the risks. I think if you see the current account sticky around the current sort of levels, perhaps around 6%, and then you get to the MTPPS in October, you see again the sort of ever shifting out sort of consolidation path for the deficit. You can see perhaps more of a perfect storm on that front around the potential for downgrade, around the external vulnerability risks. I mean, the other sort of policy side that South Africa could potentially become more risky is if it were to abandon its current sort of conservatism around currency intervention, around interest rate policy. And I think even though the rand is quite weak, we should recognise, I think the SARB does recognise, but the whole government should recognise that actually the rand is probably doing much better than if it was, say, doing a Turkey and intervening in the currency or backstopping the currency. And so the boring old SARB mantra actually is helping at the moment.